When people evaluate dividend stocks, they usually focus on one number: dividend growth. But dividend growth alone doesn't tell the whole story. A company can increase its dividend for years, while the underlying business grows much more slowly. Or it can generate far more earnings than it distributes, leaving plenty of room for future dividend increases. So today, we're comparing three metrics over the period from 2018 to 2025. Dividend growth, GAAP earnings per share growth, and inflation. Because the relationship between these three numbers often reveals far more than dividend growth alone. Let's dive in. At the top of the list is Broadcom. Its dividend grew an incredible 237%, but earnings only increased 68% on a GAAP basis. That gap is largely explained by acquisition-related accounting charges, which reduce reported earnings without necessarily reflecting the strength of the underlying business. JP Morgan tells a very different story. Dividend growth and earnings growth are almost perfectly aligned. That's exactly what many long-term dividend investors like to see. Home Depot nearly doubled its dividend while earnings grew much more modestly. The company has rewarded shareholders aggressively by expanding its payout ratio. Microsoft stands out for another reason. Reported earnings exploded more than 500%. Part of that increase comes from an unusually weak starting point in 2018, when GAAP earnings were affected by a one-time tax charge. Finally, AbbVie reminds us why context matters. Despite negative cumulative GAAP earnings growth over this period, the company still increased its dividend by more than 80%. Acquisition-related charges and the Humira patent cliff had a major impact on reported earnings, yet dividend growth continued. Apple presents perhaps the healthiest balance in the group. Earnings grew 3 times faster than the dividend, giving the company substantial financial flexibility. Procter & Gamble and Johnson & Johnson show a similar pattern. Steady earnings growth comfortably supported rising dividends. Although Johnson & Johnson's numbers include a one-time gain from the Kenvue separation, earnings still outpaced dividend growth overall. Philip Morris and ExxonMobil tell a different story. Both companies increased their dividends, but after accounting for inflation, purchasing power barely improved. In fact, real dividend growth was slightly negative over the period. That's an important reminder. A growing dividend isn't always enough. If inflation grows just as fast or faster, your income may not actually buy more over time. The strongest dividend companies aren't simply the ones raising payouts the fastest. They're the ones consistently growing earnings while delivering dividend increases that stay comfortably supported by the business itself. That's the foundation for sustainable dividend growth over the long run.